curve is extremely important because it determines interest rates, the risk-free interest rate, okay? And when you are determining the cost of debt and the cost of equity, you start with the risk-free rate. So the risk-free rate is in both equations for the determination of the cost of debt and the determination of the cost of equity. So if yield curves are shifting up and interest rates are going up, your cost of debt and equity is going up with it. If the yield curves are shifting down and interest rates are going down, your cost of debt and equity is going down. So it has a major impact on your cost of debt and equity and the value of your firm and the value of your stock. So when you're building the cost of debt, and let's say we're going to issue some 10-year bonds, first thing I want to do is go to the 10-year Treasury yield and plug that in and use that as the base rate. And now, since I'm not a federal government, I have to start tacking on risk premiums because the investors want to be compensated for risk. And let's say we are a corporation whose bonds have been rated BBB by Standard & Poor's, which is the rating agency. We're not a AAA or an A-rated company, we're BBB. So we have more credit default risk compared to some of these other corporations. So the investors are going to want to be compensated for the credit default risk premium. Since we're not government securities, government bonds, and they're 10 years, there's going to be an illiquidity issue. They don't trade a lot. There's not a lot of liquidity in them. So the investors are going to ask for an illiquidity risk premium. Since we're issuing 10-year bonds, not one-year bonds, and 10 years is a lot riskier than 1 year from now, the investors are going to want to be compensated for maturity risk premiums. The company could also be multinational, where we're subjected to currency fluctuations. They're going to want a currency risk premium. We could also be subjected to taxation changes or taxation of our bonds. Our interest, the interest on our bonds, are tax deductible. But what happens if the tax deductibility of those interest on our bonds is taken away or phased out? We're going to be subjected to a tax risk premium. The other risk premium or premiums that are not really included that I think need to be included currently, specifically right now, are policy and political risk premiums. Scalia just passed away. If Obama picks somebody to come in, that will have a major impact on how Supreme Court decisions and law is made going forward. That's huge. Depending on who the next president is, either Republican or Democrat, that's going to have a major impact on policy going forward. Depending on the composition of the House and the Senate, it's going to also determine policy that's going to be enacted and who's going to be impacted both positively and negatively. So policy and political risk premiums should be taken into consideration, although they're not. So, for example, if we're trying to build a debt cost of capital, the cost of debt, I'm probably going to start with 2%, which is the 10-year Treasury yield, roughly. I'm going to tack on a credit risk premium, 200 basis points or 2 percentage points. I'm going to add another 100 basis points for an illiquidity risk premium, 100 for a maturity risk premium, 100 for a foreign currency risk premium, and I'm going to add another 100 basis points and 1 percentage point for policy and political. So that comes out to be 8% cost of debt using the risk premium approach. To be theoretically correct, we would take 1 minus the tax rate because we can deduct the interest on the bonds, and for the tax shield, that would reduce the cost of debt. But I'm not going to do that. Usually I don't do that. I'm more conservative, and I don't use that, but it's theoretically correct to do 1 minus the tax rate to adjust the debt cost because of the deductibility of the coupon interest. To get to the cost of equity, we're going to use the capital asset pricing model, or CAPM. Okay, you need to burn that into your brain. CAPM basically states that the cost of equity is the risk-free rate plus the beta, or a measure of systematic risk, times the return on the market minus the risk-free rate. Well, we already know what the risk-free rate is. It's 2%. company's total stock return is more volatile and more cyclical than the overall stock market as measured by the Standard & Poor's 500, the S&P 500. So what we did was we basically ran a regression against the total return on the S&P 500 against the total return of our stock. And we calculated a beta coefficient. Well, the beta coefficient for our firm is 2. It means that the total returns of our stock are 2 times the market. So it's more risky. If the beta was 1, we would be exactly with the market. And if it was less than 1, we would move less than the market. But in this case, since we're a BBB company, higher risk, more volatility, I'm going to use a beta of 2. We also went back and looked at the average annual rate of return on the Standard & Poor's S&P 500 going back 10, 20 years. And the average rate of return was roughly 10%. Well, if I know that the market return was 10% minus the 2% risk-free rate, our market risk premium is 8%. So 2 times 8 is 16%. Plus the risk-free rate, our cost of debt is 18%. You also want to check and make sure that your cost of equity is higher than your cost of debt, because it always is going to be that way. Because the debt has the first claim on the cash flows. The equity holders do not. So now that I have the cost of debt and equity, I can go to our balance sheet and look at the capital structure. And the capital structure is how are we financing our assets using liabilities. So we are a $10 billion firm. Obviously, assets have to equal liabilities. We have $3 billion in owner's equity, $2 billion in long-term bonds, $3 billion in medium-term bonds, and $2 billion in short-term bonds. So our capital structure is 30% equity, 70% debt. That's how we're leveraging, and that's how we're financing the assets. Well, if I know the cost of the debt, and I know the cost of the equity, and I know the weights, 70% debt and 30% equity, I can calculate the weighted average cost of capital. 0.7 times 8 plus 0.3 times 18 gives me a weighted average cost of capital of 11%. That now becomes the discount rate that we are going to use to discount cash flows on our acquisitions. And we want to grow. So we want to buy some firms. So I looked at a company that we're going to buy, because I'm part of the finance team, or the investment team, and they basically have hired me to basically work as a pseudo investment banker inside the firm, where we can engage investment bankers to do the same thing. So the firm that we looked at has currently, last year, it generated over $100 million in sales, or $100 million in EBITDA, okay? So free cash flow, and that's what we really want to use. So it generated last year $100 million in free cash flow, or EBITDA. We think that next year the cash flows are going to grow by 10%. So in year 1, what I did was I multiplied the $100 million by 1.1. So this is my, my future value factor, right? I'm trying to get a future value. So it's 100 million times 1.1 is going to give me $110 million, which is what I'm going to use in the first year of the analysis, my first cash flow. Then we assume that we can grow out the cash flows again by 10%. So we get 121 million. Then I don't think that we're going to be able to grow them as quickly compared to the first 2 years, but I think we can do 8%. So we get 131. So those are basically my cash flows, okay, during the holding period, barring the terminal value. I know the discount rate, our weighted average cost of capital, is 11. So I'm going to start building the discount factors. So in year 1, it's 1.11 to the 1, which is 1.11. In year 2, it's 1.11 squared, so I get 1.23. In year 3, I got 1.11 cubed, or to the third power, I get 1.36. So now I got the cash flows, and now I got the discount factors. I need one more thing. I need the terminal value. And it's a 3-year holding period. We're going to go in, we're going to reposition the firm, and bring in our management, put in new systems, restructure the marketing mix, the marketing channel, distribution. We're going to take it global. So we're going to do all that stuff. So now I got to get the terminal value. So to get the terminal value, what we need to do is we need to grow out the cash flow one more year to year 4. And I decided that I would be roughly more conservative and grow the cash flow out by 5%, or multiply the cash flow by 1.05. If I do that, I get $137 million in the terminal year cash flow. Then I have to decide, and this is what the last class decided, is I have 2 decisions. Either the cash flows are going to remain flat into perpetuity, therefore using the perpetuity model, or we are going to assume that the cash flows are going to grow at a constant rate into perpetuity. The last class felt that since we were a tech company buying a tech company, that the growth rate prospects of the firm that we were acquiring should include a constant growth rate in the cash flows. So we used the Gordon growth model. I was not comfortable using the going in discount rate of 11%. I usually like to tack on some risk premiums onto the going in discount rate, because in 3 years from now or 5 years from now, something could happen to the competitive marketplace. We could be disrupted, we could be taken out, the technology could go obsolete. So to take into consideration that additional risk, I decided to tack on 2 percentage points or 200 basis points on top of the going in discount rate to come up with the terminal discount rate. Then we decided that the growth in the cash flows would grow at a constant rate of 3% forever. So now I got the equation to calculate the terminal value. So the 137 million divided by 0.1 gives us 1,370 million, or $1.37 billion. Now what I do is I take that terminal value, and I add it to the last year in the holding period cash flow, because those are the cash flows that I'm going to get in the last year. So again, I grow it out, I capitalize it, I get the terminal value, and I bring it back into the last holding period year and add it to the cash flow to get total cash flows. So if you add 131 million plus the 1,370 million, we got 1,104 million, okay, as the last year's cash flow. Well, since I know the sorry about that, back up. So I take the 131 million plus the terminal value of 1.37 billion, add them together, I get 1,501 million. Okay, I take that and I discount that by the 1.36 to get the 1,104. Sorry if I'm confusing you. So again, I just want to go through that one more time. So I grew out to the 4th year. I capitalized it to get the terminal value. I take the terminal value plus the last year's cash flow to get 1.501 billion. Then I take the discount factor for year 3 and divide it by 1.501 to get a present value of 1,104. Since I know year 2, which is 121 million, divided by 1.23 discount factor, I get 98 million. 110 million, I divide by 1.11, and I get 99 million. So now I have the discounted cash flows. Now that's all I have to do is sum them up to get the present value of this acquisition, which comes out to be $1,301,000,000. Now I got the intrinsic value, I got the present value of the cash flows. Now the question is, how much can we acquire the firm for? Well, I went to the company and I said, how much would you be willing to sell the company for? And they said, we want $1.5 billion. Well, we're coming up with an intrinsic value of $1.301 billion. If you take the 1.301 million minus the 1.5 billion, you get a negative net present value of $200 million. You would reject this project because it doesn't make sense, okay? Because it doesn't make sense. But I really want the company. I really want to buy the company. So what would I do? And I'm going to throw that back out at you. What would you do? I really want the company. I determined the cost of capital. I projected the cash flows. I figured out the terminal value. I discounted the cash flows to the present to get the intrinsic value or the present value. The present value and the intrinsic value is less than the price or the cost of the acquisition. I'm ending up with a negative net present value of $200 million. What do I do? What's the solution? How do we fix this? What would you do? I really want the company. What would you do? Could I ask for a price reduction? Could I go back and negotiate? Could I ask for a $200 million price reduction? Yeah. If I go back and I negotiate a $200 million price reduction, what does my net present value come out to be? 0. At a 0 MPV, is my internal rate of return hurdle equal to my weighted average cost of capital? At 0, when net present value is 0, my internal rate of return on the acquisition equals my required rate of return. If my required rate of return is equal to the rate of return on the asset, do I buy it? Do I accept it? If I'm getting the return I want, do I accept the project? Yes. Yes. Okay. So here, we know that the present value isn't greater than the price. Okay. But if we ask for a price reduction, the present value is equal to the price, so we're going to accept the project. Since the present value is less than the price, we ask for the price reduction in the amount of the negative net present value. Well, if we do that, the net present value turns to 0. Yes, we accept it. The IRR equals the expected rate of return of the cost of capital. Yes, we accept it. The break even in this case is equal to 3 years, which is the average time period of most corporations in acquisitions to acquire firms and at least reach break even on the acquisition. At least 3 years, 3 years or less. But what if I can't get a price reduction? What do I do? Go back to the model, start telling me where you would make the manipulations. What variables would you manipulate to get the net present value positive? Test question. You're the management team, you're the financial analyst, I'm asking you. What do we do? I already went back to the seller, they will not give me a $200 million price reduction. I'm asking you, did you make a mistake in your analysis? What variables would you go audit and review to make sure that you didn't make a mistake? Yeah, the discount rate. Okay, so maybe I overestimated the risk premiums. Maybe I didn't do a good job of forecasting the risk-free rate. Okay, maybe I overestimated the discount rate. So if I reduce the discount rate, what happens to the present value? It goes, okay, everybody sing along. If the discount rate goes down, the present value goes up. Okay, so that's one way to do it. How else could we manipulate this equation to get the present value up and the net present value up? One is to rework the the cost of capital calculations. Okay, what else? It's all right there. What other variables? There's only like 4. What did we do? Did you grow out the cash flows? Yes or no? Did you grow out the cash flows? Yes. Could I increase the growth rate in the cash flows? If I increase these growth rates, is it going to pull up the present value? Yes. Is it going to pull up the net present value? Yeah. Okay, so I could reduce the discount rate or increase, maybe I underestimated the growth rates, right? That would do it. What else? Where else did I do manipulation? Where else did I do calculation in the analysis? I did discount rates, I did growth rates. There's one more variable that we messed with. Did I do anything over here? Did I grow the 3rd year cash flow out to the 4th year? Yes. If I increase that growth rate, do you think it's going to have an impact on the present value and net present value? Yep, maybe I underestimated that. What about the terminal value? Could I have underestimated the terminal value? Yeah, if the terminal value is underestimated and I get it to go up, isn't the present value going to go up? Isn't the net present value going to go up? Yeah. So what did I do? What could I do in the terminal value calculation to get the present value to go up? There's only 2 variables. So what could I do? Okay, if I increase the terminal discount rate, is that going to cause the terminal value to go up? No. So what would I need to do? Decrease it. So if I reduce it over here, I'm probably going to reduce it over here, right? And that's going to cause the terminal value to go up. Can I increase the growth rate? Could I increase the constant growth rate using the Gordon growth model?
Yes.
Yeah, if I increase that, is the terminal value going to go up?
Yes.
Is the present value going to go up?
Yes.
Is the net present value going to go up? Yeah, I could do that. What if I can't? I could, but I really want it. I want it. I want the company. But I hired you. You guys, went through, calculated the cost of capital, figured out the discount rate, ran the scenarios on the discount rate, ran the scenarios on the growth rate, ran the scenarios on the terminal values, calculated the present value, net present value. Sorry, Professor Souza, we did an audit. We can't do any manipulation here. We can't get a price reduction. The variables that we pumped into the model are correct, and we keep coming up with a negative net present value of $200 million. I really want the company. How do I justify the acquisition? You have to go to what are called real option valuations. Again, it's not in the book, okay? But it is the standard used by most corporations, okay? So basically what you're doing is you're coming up with a value of a call option. And it's considered a real option because it's long dated. We're not going to buy this company right now, we're going to buy it in 2 years from now. So just having that time to wait and decide when we're going to buy the firm, there's total value in that. So there's time value. And the ability to exercise on the option as a manager, there's value in that. So that has to be, there's value in the call option. The ability to be able to negotiate when we're going to buy the firm, there's value in that too. The volatility in the value of the firm. If I can negotiate a price in which I'm going to buy the firm and the value goes up, I can buy it below its value. There's value in that. And if the growth rate expectations for this company are really high and the valuations are really volatile, I can wait until the value gets in the money, exercise the option, buy the firm for below what it's actually worth. So that optionality creates a real call option? Well, if the real call option minus the real call option premium, which is the premium I'm going to pay for this option, is actually the negative net present value. So I'm going to overpay for this asset by $200 million. That's actually the real call option premium. That's the price I'm paying for this option. Well, if the value of the option minus the call option premium, which is the negative present value, is positive, my net present value is actually positive. I'm going to buy the company. I'm going to buy the company. We're going to buy it. We bought this company. The financial analysis, and this is the limitations to finance. Finance is limited in most cases to the financial analysis. This is accepted methodology. Okay, this is accepted standards in the approach to valuing the firm. In the last 10 years, the real call option valuation methodology has been introduced and accepted as an approach to be able to accept projects in the face of the existing methodology telling you you should reject it. So theoretically, there are firms out there that are rejecting projects and rejecting acquisitions that are actually net present value positive. So they're missing out because they do not have the knowledge and the understanding that there are embedded real call options in these firms that are not being measured or recognized because the finance theory does not allow for it. So we had to innovate and go to option theory to then tack on to the standard financial analysis methodology to create a robust approach to be able to give us better insights into financial decision making. This is not in the book, okay? It's imputed, it's applied, it's assumed, okay? You don't have a full picture. So basically now you have the foundation, you have a lot of the overarching understanding. The book is going to help you to be able to perfect a lot of the mechanics associated with the finance. And now we can go forward and basically fill in some of the gaps and reinforce what we've already learned. Okay, that's it.